Hey guys, and welcome back to our second demo video dealing with Chapter 12. And Chapter 12 was all about differential analysis and how we make decisions. So in this video, we're going to look at Exercise 12-3. And Exercise 12-3 has to deal with a make or a buy decision. A lot of times in industry, we have or a lot of times in industry there's companies need to make a decision on should we make a component of our final product or should we outsource that. In class we used the example of computer processors, right? We talked about Macs and Dells and how HP, whatever, um, and we talked about how those companies outsource their processors, right? They buy processors from Intel. Well, what if Apple came out and says, you know what? I'm not going to use Intel processors anymore. We're going to make our own in-house. Okay, so that's really what we're doing here. Trying to make a decision on should we make a product or should we actually buy it. So in order for us to do that, um, first thing we want to do is set up our spreadsheet so we can get that done. So the first thing that we want to have is we want to have our per unit, the per unit differential costs, and then we want to have, let's see here, just going to move this down a little bit, just trying to make it look a little neater. Probably should have set this up before I did all this, but you guys can fast forward through it. This new software I have here does have editing and all that, but I haven't quite figured all that out yet. So we're actually in this problem going to make 15,000 units. That's what we need. Okay, and in our book here says that we have a engine company, and they make a variety of engines for use in heavy equipment. Um, they say that the company has always produced all the necessary parts for its engine. That includes the carburetor. So now they're thinking, okay, should we continue to make our carburetors or should we outsource them? And that's basically what we need to compare here. We need to compare the differential costs between making them versus buying them. Okay? And if we purchase these, there's obviously a cost. Cost of purchase, and in the problem they say that an outside supplier had offered to supply us the carburetors that we need for $35. Okay, so in total it's going to cost us $525,000 to buy these carburetors. Now we got to look at the cost of how much does it cost us to make the carburetors in-house. Easy peasy, right? The reason why is because they give us the per unit costs, right? So what are the per unit costs? Well, the first one is direct material. That's $14. Pretty simple. Direct labor. Well, direct labor per carburetor is $10. So that means that if we make them in-house, we have to pay somebody $10 to make an actual carburetor. Okay? Then we have the variable manufacturing overhead. In our case here, it's $3. Then we have the fixed MOH the fixed MOH that is actually traceable specifically to the carburetor division. Okay. Now notice that it has a 6 and an asterisk. Well, that asterisk says that hey, 1/3 of the supervisor's 1/3 of this cost is supervisor salary. 2/3 of this $6 cost is for depreciation of special equipment. right off the bat we think, up, depreciation, it's a sunk cost, it's an irrelevant cost, we don't include it. So when we're looking at the fixed MOH here, which is traceable, 2/3 of the 6 is actually a relevant cost. So that's $2, right? And that is the manager's carburetor manager's salary or supervisor's salary. Now, the fixed MOH overhead that's allocated, guess what? It's irrelevant because even if we get rid of the carburetor, um, we get rid of the carburetor line and we don't produce carburetors for our engines anymore, we buy them outside or from an outside supplier, that fixed manufacturing overhead, it's still there. It's not avoidable. It doesn't go away. Okay? So, what we're going to do now is just add these two up, or add up these two columns rather. What is the total cost? Well, to make a carburetor, in our example, it's going to cost us $29, as opposed to buying it, $35. So we can see right off the bat, there's a financial disadvantage of buying carburetors. Okay, now what I want to do here is just multiply everything, the 14 or the per unit differential cost for DM, DL, variable MOH by the 15, so we can get a total number here. Okay, so in order for us to do that, I'm just gonna kind of click and drag down. If you notice what I did here, I locked in that key E1, so that means that every time I click and drag, it's going to go over to the make per unit differential cost and multiply it by the 15,000. So just kind of a neat thing that Excel can do. I know we talked about Excel a little bit in class, and very important you guys know how to use it, especially you know, in the business world or whatnot. Whatever you guys may do, making spreadsheets in your future careers, Excel's pretty, you know, pretty good. So, anywho, so let's figure out. We know right off the bat we have a financial disadvantage. Well, let's see by how much. Well, that's easy. 35 bucks, actually $29 minus the 35. $29 minus the 35, negative $6. Well, what about in total? Well, in total, we have a loss of $90,000. So there's actually a $90,000 disadvantage to making this product. Now, we talked in class about opportunity cost. And what do we do with opportunity cost? This example right here did not have an opportunity cost. But if we read number 3, they say that, hey, suppose that if the carburetors were purchased, meaning we're not going to make them, we're going to buy them. So we have this empty space within our factory. And we say that we as the company could use this freed up capacity to launch a new product. The segment margin of this new product would be $150,000 per year. Now we have an opportunity cost. Okay? Remember, the opportunity cost is what you give up to get something. Pretty easy. So let's look at what happens if we take this into account. Okay? So what's the cost of buying? Well, we already calculated that. Cost of buying is the $525,000. What's the cost of making? Well, we already calculated that in requirement 1. Cost of making is $435,000. Now we have this opportunity cost, okay? So we say opportunity cost. It's what we give up to get something, okay? If we decide to make our carburetors, what are we giving up? We're giving up $150,000 of segment margin. So I'm going to put that underneath the make section of 150,000. So now when I add up all my costs, we can see that there is actually a financial advantage to buying. How much? Well, again, it's the difference between the 585,000 and the 520,000. So in this example, my financial advantage to buying is actually $60,000. Okay? So that's a make or buy decision. When we come back in our next video, we're going to look at exercise 12-4, which has to deal with special orders. And we'll talk about that a little bit as well. So tune back in for our next video.